Oh, one of the questions that we get, yeah, a lot, or I see written about, just like, should I just invest in the S&P 500? I look at past performance. It's like, hey, why don't I just invest in the S&P 500? So we're going to unpack that conversation now. So the S&P 500 top 20 holdings represented, basically as of this month, are these 20 companies. You can see their weighting. So, for example, I'm going to run through a few of these. NVIDIA represents 7.8%, Microsoft 7%, Apple 5.9%, and then the cumulative weight is just adding them up, right? And so when we get through that whole list of 20 companies, right, the S&P is 500, so automatically we'd say, oh, we're really diversified with 500. When we add up these top 20 and you look at the bottom right, this shows us that you're at a cumulative weight of 46%. So essentially the top 20 holdings are roughly 50% of your allocation. Now, the good news with that is we have a lot of great companies in here that can be owned. But one of the things that we're big believers of is over time we want to have, especially with our larger stock portfolios that are direct investing in a larger basket of stocks, is we want to make sure we have more diversification. So I'm going to give you a little bit of just a history on this. Is if we broke the market into three separate categories. On the far left-hand side, this shows the S&P 500. We already talked about how the top 20 holdings drive 50% of the allocation. But then more importantly, you can see this is a Morningstar style box, large, mid, and small. What we're highlighting here is there's no small cap. Now, over time, if we look back over the last 100 years, smaller cap stocks have outperformed larger cap stocks over a long period of time. That has not been the case for the last 10 to 15 years, though. Large has done better. But we're big believers of when we're diversifying, we want to look at the entire market. And so a better potential index for that is the Russell 3000, right? You can see here, there's still a heavy emphasis on large, but you can see there's small company exposure. If you add up these 3%, 4%, 2%, there's roughly 9% in small exposure. And then a big core part of the portfolio is using the DFA Core Equity 2 ETF. I'm not recommending this per se on this, but just giving this as an example. You can see has some higher small cap exposure, some a little bit higher mid cap, and significantly less large, right? And so it just is, this portfolio is built more to be more broadly based. And so when we look at that, and I'm going to give an example of like what broad diversification looks like, the S&P has been a really hard fund to beat for the last 10, 15 years. But I'll show you there's been some times where the S&P has not been the best index to own, which is why we believe using a broader index is more applicable. So a lot going on here. This concept of winning even when it doesn't feel like it. So this is only updated through the end of 23, not through the end of 24. So we do have a little bit of data that needs to be updated. So we do need to update this, but the concept still makes sense. So we went through a period, I've broken this down into a couple categories. A period where value outperformed, and that was 2000 to 2008. A period where growth outperformed. And then looking at the total return through a full market cycle of 24 years. So when we start thinking about diversification, let's just look. I'm going to give you some examples here. In 2000 versus to 2002, so for 3 years, the S&P lost 40. A diversified portfolio of equity lost 19. In 2003 to 2007, so sorry, the emotion is I lost money, right? The S&P lost 40, I lost 19. Neither scenario is good. Clearly, the diversified portfolio did a little bit better, but you still lost money. Then we went through a 5-year period where diversification worked. The diversified portfolio, which has U.S., large, mid, small, international, emerging markets, did better. And then in 2008, the more diversified portfolio, I lost more money, right? And so through that cycle, though, a $100,000 invested in the S&P was worth around $70,000, and invested in diversified was around $117,000. So obviously, this shows the case for why diversification can really work. The reality is, when we look at the rearview mirror, which is the last essentially 14 years. Through almost every little cycle that I went through, 2009 to 19, Q1 of 2020, which was the start of COVID, through the last couple of years, the whole emotional feeling is I didn't make as much, I lost money, I didn't make as much, I lost money, I didn't make as much, right? And even though like 2009 to 2019, the S&P made 351, a diversified portfolio made 317, still really good, but it still didn't make as much. So if you're tracking against that benchmark. And so when we look at that, 100,000, you can see grew to quite a bit more in the S&P than it did in a diversified portfolio. So many investors are using that lens of saying, well, why shouldn't I just invest in the S&P? Because clearly this data would show me, especially when I just look at the last 15 years. Now, when I take into account this whole 24, 25-year period, now you can see that the more diversified portfolio did better over a long period of time, and that's why we put the note there. It wins even when it feels like it's losing. And so I'll add the 2024 data. It does improve some of the S&P returns, but this is just a reminder that we have these long-term cycles that can essentially go against you for a period of time. We've been living through a growth outperformance, but that's not going to happen forever. And again, diversification is what matters. Portfolio rebalancing is what matters, is bringing things back into alignment over time. If you're new to Vance Wealth and you're just uncertain about what's happening with your tax strategy, your investment approach, or you just want a second opinion, we'll do a complimentary consultation. So please just reach out so that we can, we'll want to gather some documents, ask you some questions, and then we'll be able to give you a report that does a deep dive on your investments and your plan and give you some guidance, and maybe would be a good fit to help you on a go-forward basis. You can reach us, you can schedule an appointment, just go to vancewealth.com. And you can schedule an appointment there, or you can call the office at 661-775-0950. Thank you very much. I hope you found our 2025 mid-year economic and market update valuable. Again, please like and subscribe on the YouTube channel, and we're looking forward to reconnecting in the future on our next video. Thanks.